My name is Jeffrey Kennedy, and welcome to Elliott Wave Junctures. This week we've looked at a number of different trade setups. We've looked at throwbacks and pullbacks, and we've also looked at price gaps. Today we're going to look at another type of trade setup that involves an indicator, specifically the MACD. MACD stands for Moving Average Convergence Divergence, and it was developed by Gerald Appel. The MACD indicator typically is exhibited as this is, with two lines. One line, in this instance here, the blue line, is the MACD line. Now that's the result of the difference between two exponential moving averages. The black line is simply a moving average of that MACD line, and that's referred to as the signal line. So the MACD indicator is comprised of two lines, one being the MACD line, the other being the signal line. Now the way I utilize this to identify a trade setup is I look for something called a zero line reversal. Now the MACD indicator is not a banded indicator like say stochastics or RSI, so it fluctuates around zero. Now a zero line reversal occurs whenever the MACD and the MACD signal line move down to or up to the zero line and then seem to reverse at the last moment. For example, this would be a zero line reversal in the Dow Jones Industrial Average on the weekly chart level. Here's another example of a zero line reversal. Now the good thing about this indicator and the setup, the zero line reversal trade setup, is that it occurs in all markets and all time frames. Here's soybean meal. And here are two very good examples of zero line reversals. Notice in this instance earlier in the year, back in late, I believe that was May, June, we saw the MACD and the MACD signal line come back to zero and then reverse. And then conversely on the opposite side, we saw once we got below the zero line, we saw the MACD and the MACD signal line push up to zero and then reverse. That's a bearish zero line reversal. Here's an example of zero line reversals in Caterpillar, ticker symbol CAT. This was a bullish zero line reversal in late 2011. Here we had a bearish zero line reversal that actually corresponded or coincided with a wave 3 sell-off in Caterpillar. And recently we've actually completed another zero line reversal. And I believe we've actually spoken about Caterpillar in Elliott Wave Junctures because the move we've seen to the upside recently is a 3-wave move, which makes this example even more interesting because of a number of actual additional components from a technical perspective that we can look at, which actually paints a bearish picture in this market. For example, we have the zero line reversal. We have a 3-wave move up. Notice how the black line, which is a 50-period simple moving average, is acting as resistance. Also, too, we can identify this as a head and half shoulder formation. This would be the left shoulder, here's our head, and this would be the right shoulder or the half shoulder formation, arguing that if we can take out the trend line or the neckline in this instance, it would clear the way for a sizable sell-off, most likely to about $70 a share. And the final example of a zero line reversal is on an intraday basis. This is a 120-minute price chart of the E-mini S&P. And again, I like to combine technical studies with the wave principle. For example, in this instance here, we can make the case that we're working a very small contracting triangle in the E-mini S&P, and then combine that with what appears to be a zero line reversal. And if we subtract the difference between the MACD line and the MACD signal line, that gives us the MACD histogram. Notice where we're having a decrease in momentum as prices have been moving sideways, which is very indicative of a contracting triangle. So what I'll be looking for here as we move into today's trading and tomorrow's trading is for the S&P to actually continue to push lower in conjunction with forming a zero line reversal. Thank you very much.